Hello, everyone, and welcome to Empowering Female Investors. My name is Jennifer Russell, and I'm with Independence Wealth Management. Let's dive in. Here are some empowering statistics for us to consider. Now, who can tell me which of these is true? In the workforce, we've got 1.3 billion women worldwide participating, and then another billion could enter in the next decade. Women globally are controlling more than 70% of global consumer spending. That's 20 trillion. Or what about this? 11.2 trillion. Women have influence or decision-making control over that much money, of which 5 trillion they manage all on their own. You think that's true? Well, actually, these are all true. You can see that we have a lot of reasons for optimism when talking about women in the economy. Women are taking on a greater role in the economy and controlling more wealth than ever before. We're overseeing financial decisions for our families. We're taking on greater professional roles and earning larger percentages of household income. We're educating ourselves and earning the majority of all bachelor's, master's, and doctoral degrees in this country. We're starting our own businesses at a greater rate than ever before. In short, we have economic clout. And yet, women still lack confidence when it comes to investing. Many women face common financial planning challenges. Such challenges are unpredictable life events. 9 out of 10 women will be solely responsible for their own finances at some stage of their lives due to events such as divorce, aging or death of a spouse. We also face economic realities and retirement planning hurdles. Women still earn 20% less than men for the same job. This is compounded by unique events like having and raising children or caring for elders. We also have a longer lifespan. We're living longer and outliving our spouses or partners. We're leaving us much more likely to be alone in our retirement years. Also, fear of making a mistake. Of women over 65 living alone, 4 out of 10 depend on Social Security for virtually all of their income. Women tend to be more conservative than men when it comes to their asset allocation. That causes them to underinvest. Now, the good news is these challenges can be overcome through education, good planning, and confidence building. It turns out that women lack financial confidence, but they underestimate their financial strengths. Perception does not appear to match with reality. Women are financially literate as men, but their confidence doesn't match that. Women do want to be more engaged in their finances. 92% want to learn more about financial planning, and 75% want to learn more about investing within the next year. Because of this lack of confidence, women tend to underinvest their portfolios. 29% are inclined to pick the most conservative asset allocation, which means they're holding cash and fixed income over stocks. Now, that might work for some, but it's not going to be appropriate in all cases. So let's empower the female investor. We'd like to help you gain confidence and take control of your finances. In 7 steps, every letter of the word empower represents a step towards helping you put your financial plans into action. And action is the key word. The key difference between a dream and a goal are the actions you take. Let's get started. The first step to empowering yourself is E. Evaluate your situation, which is a combination of 3 factors. 1, what are your priorities? These are your values, your intangible feelings or beliefs such as independence or the importance of early retirement or giving to charity. And it makes a difference when you were born. We notice that baby boomers, Gen X, and millennials, they all have different life experiences and therefore have different values or priorities, what's important to them. Number two, your responsibilities. These are things such as tangible car payments, school loans, mortgage payments, your cash flow. And last, your dreams. These are things you aspire to, such as more travel, a new home, a different lifestyle. Setting and prioritizing your financial goals is a process that should take all three of these factors into consideration. And you want to make sure your goals are measurable, meaning how can you track your progress against them, make them achievable, meaning are they realistic over a given time frame, and are they compatible? Are they consistent with your lifestyle, your income, and your values? The key is to know what's important to you and plan how to make that a reality. So here's what you can do to get started. After you've done a little soul searching, it's time to examine your credit history and your insurance coverage. Now, that may sound a little bit intimidating or a little stressful, but here's what you can do to get started. On your credit, you're entitled to one free copy of your credit report every 12 months from each of the 3 nationwide reporting companies. Here are their phone numbers. You can jot these down. They're Experian, TransUnion, and Equifax. Okay? When you receive your credit history, check it for accuracy. As you examine it, you want to make sure you know, do you have credit under your own name? To build credit, you simply start using credit cards to make purchases, but you also want to make sure that you're paying off your bills on time. What I do is I use a credit card for all of my purchases. I use a credit card that gives me rewards like cash back or mileage points. And then I put every purchase on there that will accept a credit card, and then I pay them off in full every month. So that way I'm getting the rewards, and I'm not having to pay any interest. Do you understand your credit score? First off, what is a credit score? A credit score is known as a FICO score, and it can fall within a range. So FICO stands for Fair Isaac Corporation. That's who issues the score. And we've got 300, which is the worst, and then all the way up to 850. Now, at 850, you're going to have strangers on the street trying to lend you money. This number, this credit score, can determine everything from the interest rate on your mortgage or your auto loan to whether you'll be approved for a credit card to whether you can rent an apartment. Needless to say, it's very important. And if you already know this, then make sure your children know it. At age 18, as they're getting ready to go off to college possibly, they're going to receive a lot of invitations to apply for a credit card. Be sure they know how to use it responsibly and the impact of their credit score, how that can affect them. Next, are you comfortable with your credit limits? For example, what's the maximum amount of credit card amount that a credit card company will let you have on your card? Are you comfortable with that? Make sure number one, that you stay within that limit, and then is it on the high side? For me, I know that my limit was much more than I felt comfortable having on one credit card, so I actually asked them to lower it. My reason being, I don't want someone to steal my card and be able to rack up that much debt. I know they have, protection for me in that regard, but it doesn't make sense to have that much on a credit card. So know that you can do that for yourself or for your children. And lastly, how much do you owe and at what interest rate? If you're in a position where you have different debts, look at them. Look at how much interest rate you're being charged on your car loan, on your credit cards, on your mortgage, on your student loans. If you're trying to pay them off, it may make sense to give priority to paying off the interest rates that are highest. Now let's look at insurance. Do you have insurance? I hope you do. And then what kind of coverage do you have? With your life insurance, is it term, whole life, universal? Do you have health insurance? Do you have car insurance? I hope you do. It's the law. What about home insurance? It's going to be required with your mortgage. It's good to review the terms and the costs of your coverage with a professional when you want to make sure you're not overpaying. You also want to make sure that you're adequately covered, and also that you're not overinsured. You can get your car insurance may cover things that when you rent a car, they're trying to insure you for that as well. So it makes sense to just review that with a professional and make sure you're adequately covered and not overinsured and not paying too much. Now, the next step in empowering yourself is M, manage your finances. And we do that by building your own personal balance sheet. Corporations create balance sheets and income statements to get a better assessment of how they are doing. So why shouldn't you? It's difficult to put an investment strategy in place before you've organized and understand your expenses, savings, debt, etc. Until you know exactly how much is coming in and how much is going out and how much is left over, you can't put a smart, disciplined plan of investing in place. First, you need to establish what you own, what are your assets, and also how much you owe, what are your liabilities, to arrive at your net worth. Once you've established that, you can figure out how much money you have coming in and subtract how much you have going out, going towards paying your rent, making the car payment, buying food, clothes, or investing. And hopefully with solid financial management, you're going to have a positive cash flow left over after you've subtracted all your expenses from your income. Now, I was told at a young age, and I'm very grateful for this, that it's important to live beneath your means. So know what you have coming in, know what your fixed expenses are, and with your flexible or discretionary expenses, make sure that they're less or significantly less than what you have coming in, because you want to be able to save and invest. Now, I am all for pampering myself and treating myself as a woman of worth, and occasionally indulging on those luxurious items. And I recommend that you do that. Make sure that it fits within a spending plan. You don't have to do it every month or every week. Make sure you're doing it in moderation and what matches what your income is at currently. And know that it will change. Where you're at today isn't where you're going to be. But you want to work with what you have. As you plan for your future, it's important to establish an investment plan. To do this, you want to invest early and often. Having time on your side can pay off by implementing a saving strategy known as compounding, where interest is compounded to add even more value to the investment. Now, this is neat. Interest is what you earn, say if you have a money market account or you've got a CD at the bank, or even if you've got a bond, you're earning interest on those investments. Okay? Awesome. Your money is making money for you and you're not having to do anything. That's a great feeling. Compounding interest is then the interest that your investment makes, or that your money makes, making more money. So the money that your money makes more money. That's compounding interest, and it's powerful. Here, let's look at what it does. This graph we have is considering 4 different people. Each of them started out with $10,000. Okay, the dark blue invested $50 a month, and the light blue invested $200 a month. Okay, then we have 2 sections. The first section invested for 10 years. The next section invested for 20 years. Okay, so let's start out looking right here. We have someone that started with $10,000 and they invested $50 a month. At the end of 10 years, they had $35,000. Awesome. So that was 10 years. It's safe to expect that after the end of 20 years, 20 being twice the amount of 10, that you would have twice the amount that you have in 10 years. So you would have 70,000, 35,000 times 2 if you're doing twice the amount of time. But what actually happens? Do they have 70,000 at the end of 20 years? No, they have $113,000. Why is that? Right? Because their money made money. The money that their money made money. That's compounding interest. It's powerful. The earlier you start investing and saving, the more time you have to benefit from the power of compounding. It's also important to talk to your kids about this. It's much easier to start saving for retirement straight out of college, or even in high school, to start saving that money away, because the more time you have with your money earning interest and earning a return, the bigger the effect, the potential effect of compounding interest, okay, or compounding returns. Now, in addition to the power of investing early and often, it's also important to diversify your portfolio, diversify your investments. Since it's impossible to predict exactly what's going to happen next in a changing economy, who predicted a lot of what happened last year, investors need to incorporate an array of asset classes in order that their portfolios have the strongest positive effect on performance. You can see from this picture, the traditional portfolio has fewer asset classes than a core and diversified portfolio. So how do you start building a core and diversified portfolio? Well, let's back up a minute and start talking about diversification. Core investments provide a broad foundation comprising of U.S. stocks, U.S. fixed income or bonds, and a developed market of international equities. Okay? The main types of risk inherent in these investments are those naturally associated with bond and stock markets, such as interest rate and equity market risks. Now, investors can surround their core holdings with diversified investments, such as emerging market, real estate, emerging debt, and high yield bonds. Although these new investments are going to introduce a different layer, a different kind of a risk, they also offer stronger diversification benefits and an opportunity for a skilled portfolio manager to capture excess return potential. Because when interest rates go up, that is going to impact your fixed income or bond investments, and it may impact some of your equity that are paying a large dividend. But in an emerging market, emerging country across the world, they don't care what if interest rates are going up in the US. That doesn't affect them as much. So the return you're going to get on the section of your portfolio that's invested in emerging markets may be greater than the return you're getting in the fixed income. So by having those investments together, it further diversifies your portfolio and helps promote your returns for the risk that's involved. We believe the most investors can benefit from taking a traditional portfolio and enhancing it by delineating between the core and these satellite asset classes. The core is going to be approximately 70 to 80% of most investors' portfolio, and then the diversifier investments will comprise of 20 to 30%, offering the potential for risk and return betterment. Investment portfolios are built for a reason, namely to reach specific financial objectives. We believe that to have the greatest potential to reach those objectives, investors should first identify what their objectives are, and then work with an advisor to construct a portfolio that helps achieve those objectives. For example, if you're someone who is looking for tax management or to reduce some of your tax concerns, we would focus on core assets that are designed to maximize your after-tax return potential. So creating a core and diversified portfolio is all about seeking to maximize your risk. Sorry, that's not right. We're seeking to maximize your risk-adjusted return. Because I can stand in front of you and say, I've got a great portfolio. We're making 20% a year on average. Great. But how much risk are we taking to get that average return? We could be getting a 20% average return by going up 40%, down 40%, up 40%, down 40%. That's an average return of 20%. Or we could be getting an average return of going up 20%, up 20%, up 20%, up 20%. Now, two portfolios can have an average return of 20%, but which one ends up with more cash at the end of it? The one that's consistently going up 20% is going to have more cash at the end of it than a portfolio that's going up 40, down 40. Okay? The up 40, down 40 has more risk. It has more volatility. And so when we say we want a portfolio that's got great return, but it's a risk-adjusted return. Okay? This means potentially improving your chances of achieving returns for every degree of risk that you take. Okay? Diversification does not protect an investor from market risk and does not ensure profit. Now, the next step is O. Own and protect your assets through capitalizing on tax-advantaged retirement planning vehicles. As you save for retirement, you'll want to consider all investment options. One example is a 401k plan that offers pre-tax contributions as well as tax-deferred compounding, which is going to capitalize on reinvested earnings. You may have seen that from your employer. Because no current taxes are paid on the amounts earned in a 401k plan or a variable annuity or an IRA, your account can compound and grow much faster than a taxable investment earning the same rate because earnings accumulate tax-free. So how does that work? If you've got a 401k earning 5% a year and you've got an after-tax account earning 5% a year, at the end of the day, you're going to have more money in your 401k because each year in the taxable account, you're making 5%, then the government says, oh, you made 5%. You owe me some money. So you have to pay taxes on the 5% you earn each year in the taxable account, whereas you don't in a 401k. So at the end of 10 years, when each of them has been earning 5% a year, you'll have more money in the 401k because the IRS wasn't taking taxes out each year. Okay, so the advantages of using a tax-deferred account can be great. You want to speak with your investment professional to determine which tax-advantaged retirement plans are available to you because there are requirements and there are restrictions around different ones. How many of you own your own small business? Awesome. There are tax-efficient programs that you can take advantage of, such as a simple IRA, a SEP, a simplified employee pension, or a qualified retirement plan. Now, let's talk about these a little bit more in detail. Simple IRAs are savings incentive match plans for employees. We're talking about this column right here. It's easy to set up, and it might be a good choice if you have employees and you want them to make their own contributions. Because as the employer, you're required to make a small matching contribution of 1 to 3% of each employee's compensation, even your own. So for 2015 or 2016, last year, eligible employees may have contributed 100% of their income up to $15,000, and participants who are 50 or older can make an additional $2,500 catch-up contribution. Now, a simple IRA must be in existence by October 1st of the year in which contributions are first made or claimed. Now, let's look at a SEP or a QRP or KEO. That's these two right here. With both of these plans, the employer makes contributions, not the employee. With this arrangement, employers contribute to the traditional IRAs, the SEP IRAs, and set it up for the employees. Now, a QRP is a qualified retirement plan for the self-employed, sometimes referred to as a KEO. The tax-deductible contribution limits the SEPs and the QRPs. The limits on them are much higher than with a simple IRA. So 25% of employee compensation, or if you're the owner, you have 20% of that self-employment with a $52,000 limit. I'm sorry, that's up to $56,000 in 2016, 2017. You can set up a SEP IRA as late as the due date of your tax return. That's for a SEP. And then a QRP, it has to be in existence by December 31st of the year in which you want to make contributions. So there's a lot of different nuances to these different plans. And so it helps to talk with a professional to get a clear perception of, okay, here's my situation, what makes the most sense for me, what can I invest in, and what are the limits. The IRS has a SEP checklist, and you can find that useful, or there's a publication on the retirement plans for small businesses. I can help you with that. After you capitalize on the tax advantage vehicles, it's important to protect your assets through smart investment planning. Here are 5 documents everyone should have. Now, you want a will, a healthcare proxy, durable power of attorney, guardianship provisions, and a trust. So, death is one thing, disability is quite another. If, God forbid, something happens, you want someone you designate to be able to make decisions on your behalf in case you can't. Or if you have a spouse, you want to be in a position where you can access cash if you need to, if God forbid they're in a coma and you need to pay medical bills. We want to make sure you have power of attorney, you have guardianship provisions so that you can, act and continue, taking care of responsibilities even if something has happened to your partner. Now, what about a will? Most people have that, but what about a trust? What's the difference? Well, there's a lot of differences, but one of the things that you can do with a trust is you can further extend your control over your assets. Now, with a will, there's a one-time transfer, saying, okay, I want this account to go to this person, I want this other account to go to that person, and you're done. With a trust, you can say, okay, I want this account to go to that person, and if something happens to that person, I want it to go to somebody else. So you have an extended control even after you've passed on. When you're setting up these documents, keep your family involved. Make sure they know what your wishes are and where you're at in the estate planning process. It's not the most fun conversation to have, but they will respect you for it and appreciate it if, God forbid, anything happens. The 5th step is to work with a financial advisor. You don't have to do this alone. You rely on professionals almost every day. You put your children's education in the hands of skilled teachers. You entrust your health to your doctor. So don't your finances deserve the same amount of professional attention? Here are some considerations when selecting an advisor. What are the valued attributes to look for when selecting an advisor? Style. Do they have good fashion sense? That's not what that means. No, we're looking at what are their communication styles. Nearly half of investors admit to being unsure about the best way to invest their money. Your advisor should be able to help you articulate your financial goals and then formulate a long-term plan to achieve them. Connect with their communication style. How do they communicate? Do they listen to you? Are they patient and organized? Is that important to you? And their capabilities. A financial advisor should also have the capabilities to suggest an investment strategy that is suitable for your specific goals, your time horizon, and your risk tolerance. He or she should be able to provide a range of services and be willing and able to teach you about your investments if you want that. They should also offer an objective perspective. Financial advisors may offer guidance and discuss with you options that could prevent you from impulsive behavior. Now, people can get very emotional about making decisions about their money. It happens a lot. There's nothing wrong with that. It just happens. We are human. But emotionally triggered investment decisions can have weighty consequences on your savings. Okay, so working with a financial professional can help you put current market events into perspective and help you be confident with your long-term decisions, even during economic downturns. Okay? Remember that discipline is an essential element of long-term investing success. Now, expertise. The financial advisor, that term applies to individuals within a range of occupations, titles, who've been formally trained and serve the needs of investors. The Securities Exchange Commission requires anyone who gives investment advice to file a form that details their services and practices, while many states require that financial advisors pass specific exams. Okay? Financial advisors are also often experts in other fields like accounting, real estate insurance, taxes, or insurance. And lastly, fees. At the end of the day, fee structure matters. Okay? Are they charging a flat rate? Are they charging you based on the value of your assets? Or are they driven by commissions? All of these are very important to note. E. It's not enough to hire an advisor. You still need to educate yourself. Okay? By staying informed, you can empower yourself with knowledge to invest intelligently. By reading publications like Wall Street Journal, The Economist, or market updates from your advisor. They've been created to make complex market events easily digestible into sound bites that's easy to understand. You can also watch TV programs or listen to podcasts. Better yet, you can browse the web or partner with your investment professional to learn more about what's going on. And certainly bring up any questions you have as you read through articles. Because sometimes news people and reporters are there to sell the news. And so things can look really emotionally juicy when you're watching them. So if you have questions, talk to your advisor, and they might have some, in-depth research reports that can help you really look at the situation with a different view. The final step is review. This is not a set it and forget it program. Sound financial planning requires you to regularly review your plan and consider each of these 7 steps at least annually. You are going to change. Your circumstances are going to change. The market is going to change. So it's important to review this on a regular basis. Now, we have covered a lot today. Here are the key takeaways. Women in economics continue to be a long-term, powerful topic. Women continually are increasing the value to the global economy. Women have financial acumen, but continue to lack investment confidence. We know that the key difference between a dream and a goal is the action you take. We can help you gain confidence, take control of your finances. And you started the process today. By utilizing the 7 steps together, we can empower the female investor. And I am available for questions. And contact me after this publication. I am very happy to answer any questions you have. Thank you very much.